So Liana, now let's get on to a really interesting conversation. And I love this conversation because I see people on YouTube which really are not qualified. And what they actually do say is they come up with a lot of myths that do appeal to people, but are not true. They're generalizations. And one of those big misconceptions or big myths is apartments are not a good investment. And in fact, that statement is false, okay? So even though here at Freedom, probably about 90% of what we do is houses with a land component, a healthy land component. We also invest into apartments and townhouses, especially for our sophisticated investors, Liana, and also ourselves.
Yep.
We do a lot of, I just settled on a great apartment in Brisbane. I've made tremendous gains there, very happy with that. We just had about 80 of our members just complete some really great affordable townhouses in Brisbane. They've made huge capital gains there. So the first thing that I want to share with you is this, is that when you're a property investor, you do start to get penalized for holding a lot of land. And in fact, we've had a lot of investors that come to us, they're screaming out for help because they thought they've done the right thing. They bought all these houses and land, and then their land tax bill comes in, and it's $12,000 for the year. It's $22,000 for the year. And they didn't know they were gonna run into that problem. And that's something that you need to calculate up front. And one of the reasons for that is there is land tax in Australia, and it does appear that state governments are getting a little bit greedy. They've got their eyes on property. There's a lot of wealth creation in property, and they're looking at land as a way and taxing land to bring in more revenue. So depending on what happens in the election in March, whether we see Labor Greens, whether or not we see Liberal, and I think if we go more on the Liberal side, I think the pressure on land tax will dissipate. But I think if we stick with Labor Greens, I think there will be more pressure in terms of land tax. But in Queensland, for example, once you own more than $600,000 of combined land, you've got to start paying land tax.
That's in your personal names only. So we're not talking about other structures like trusts and companies and other entities. They have very different thresholds, but we're just talking about individuals holding land that's other than your principal place of residence, so your investment properties, for example. So they do combine the total value of the land and calculate land tax on that basis. And a lot of people don't understand that until they get hit by the land tax bill. They realize, oh, there's land tax. So one of the things that Victoria did last year with the Dan Andrews government, his parting legacy was to lower the land tax threshold in Victoria quite significantly. That's proven to be very ineffective and extremely unpopular with investors, obviously. So that's something to watch out for. However, the stamp duty reduction that's coming in, it signals the start of the government wanting to actually remedy that situation. So they are trying to encourage more investors to come back to the market. So watch this space about Victoria in terms of land tax legislation. There's a potential that might reverse.
Yeah, it's really important that when you're going to build out a property portfolio, this is something you're going to build out over 10 to 15 years. You want to sit down with a professional to figure out what is your diversification plan in terms of the structure, in terms of the geographic locations, in terms of the property types, so that you can limit your land tax and all taxes. And I hear too many people say, oh, you shouldn't invest on the basis of taxes. Well, you shouldn't invest on the basis of any one thing alone, but you should be investing on overall wealth creation. And one component of overall wealth creation is your tax. You've got to factor in the tax impact of your overall portfolio, right? Any intelligent person, I think, does understand that. So you got to sit down and you got to factor that out. And one strategy is once you start building up that property portfolio, you can and you should start moving towards strata properties so that you can limit that overall land tax and improve your cash flow. But you'll still get capital growth, and we'll give you some examples of that.
So there's definitely a place for strata properties, because one of the biggest advantages they have is actually they have minimal land tax. And even with the thresholds in Victoria, for example, there are properties like you can buy an apartment and pretty much not pay land tax in this scenario. The other thing also is, why we're actually recommending people buying brand new properties. That's because it maximizes your tax deductions, which significantly improves your cash flow. And you cannot underestimate that, because the tax deduction could amount to $10,000, $15,000, or even more than that per year for a number of years. So that's a very significant impact, has a significant impact to your cash flow. So we cannot ignore that. That should be part of the equation.
Now you can see here, I've got an example here. This is Millers Point, okay? Now this is an apartment in Millers Point. It's about 168 Kent Street in the Sydney CBD, near the Crown. Now a 3-bedroom apartment there in 2003, you could pick it up for 1.1 million, all right? Now, the current price For this property, it was recently sold for 3.85 million. This is 250% capital growth during that time. Now I went and I got the research team to find like a house, a terrace home in this case, which is literally a 3-minute walk away at Dawes Point. And you can see here, it's a 3-bedder. The purchase price in 2003 was 2.4 million, and the current price is 7.1 million. It was just sold and purchased, and the capital growth there is 188%. So this is a great example of where if you pick the right apartment complex, the right apartment, the right price at the right time in the right location, then you actually can outperform houses. It can be done, and it is done in many cases.
The two major misconceptions that we wanted to dispel here is, number one, houses always do better than apartments. That's absolutely not true, because apartments in the right markets, apartments actually outperform houses in the same market, same area. And we've got lots of examples of that. The second myth we want to dispel is cash flow. A lot of people complain about the body corporate that you've got to pay in apartments. So we're going to also show you
the cash
real live examples. These are properties we have available for sale now, the cash flow projection on those properties. One of them is a house, one of them is apartment. And you can see that the cash flow, the overall cash flow after everything, all expenses, tax deductions, rental income taken into consideration, is actually outperforming houses in cash flow.
So Liana, even with body corporate, I can be better off on the cash flow and better off on the capital growth if I've done my research and picked correctly on an apartment.
Yeah.
Okay, so let's take a look at this one. This is Port Melbourne, 3-bedroom apartment, was picked up in 2000 for 480,000, was just sold for 3.1 million. The capital growth is 561%. Now, a 3-bedder home in this exact same suburb of Port Melbourne, the purchase price was 580,000. The current price, it was recently just sold for 2.5 million. The capital growth is only 338%, okay? Brunswick, we see here a 2-bedroom home with land, picked up for 171. This 2-bedroom apartment, picked up for $96,000. 858% growth versus 526% growth. So what I'm going to do here is I'm going to give you an example on the cash flow, okay? So we're going to look at an apartment, and these are all the property expenses here for the apartment. And here's the purchase price for the apartment. Here is the deposit down. The rental yield is higher than the house. Here's the house, the rental yield here is only 3.5%, and that is typical, okay? You're normally getting 1 to 2% more rental yield on an apartment over a house in any market in Australia. Typically, that's exactly what's happening.
These are, by the way, two real examples. These are two properties we have for sale right now. Yep. On the left-hand side is an apartment in Melbourne. On the right-hand side, it's a house in Melbourne.
Yep.
So same city, but just same price. So we just wanted to share with you the comparison in cash flow.
Now you can see here, we've got council rates, water rates, land tax. In fact, that's actually way too high for the apartment. It should be a lot lower than that, but let's just keep it at $1,000 to keep the numbers round. And then you've got the evil body corporate fees. And these are the evil body corporate fees that make apartments the worst investment on the planet. And then you've got repairs and maintenance, you've got your property management fees. But again, remember, you do have rent at 4.4%. So your rent is $670 per week versus $550 per week. This is a real example, guys, that we are using. Now, if you get a brand new property, and there are a lot of advantages to brand new property. I've done a YouTube video on the advantages of brand new. You can make money with existing, you can make money with old, but you can also make money with brand new. But there are some advantages to doing brand new. And one of them obviously is the stamp duty getting scrapped recently. But there are a lot of advantages to brand new. I won't go into it, but one such thing is the tax deductions you can get. So if I look at this income, and if I actually look at these expenses and I include depreciation into the calculation, this is the cash position annually for the year for each property. So the house is in blue for year 1 and the apartment is in orange. So at the end of the year, after you get your tax refund, you can also get that tax refund monthly or weekly. At the end of the year, including the tax refund that you get on the property, you will be negative $11,000 a year on that property. And for the apartment, you will be negative $7,000 a year on that property. So you are actually better off at a cash basis week to week with an apartment than what you are on the house. Now, the argument might be made, well, the house is going to have more capital growth. Not necessarily, okay? Not necessarily. If you pick the right apartment complex in the right area, the capital growth on apartments in that area can be more than the houses in that area, and in fact, houses in any of the areas surrounding.